Control of credit supply by RBI. The Reserve Bank of India will control the supply of credit in the economy. The supply of money in the economy are done by the central bank of the country, by the government of the country, and also by the commercial banks. The ways in which the supply of money is going to be done are different in all these three cases. And we have known that RBI is the regulator and the controller of credit in the economy. RBI is the authority which will look into the matter of credit creation by the commercial banks. And why does RBI do that? Let's have a look at the official website of the Reserve Bank of India. Monetary policy refers to the policy of the central bank with regard to the use of monetary instruments under its control to achieve goal. What kind of goal? The primary objective of the monetary policy is to maintain price stability as given in here, while keeping in mind the objective of growth. So price stability is a necessary precondition for sustainable growth. And in order to achieve that, the Reserve Bank of India is going to use certain instruments through which credit control is going to be taken care of. And when we talk of these instruments are going to be of two kinds. Firstly, we have quantitative instruments, and secondly, the qualitative instruments. Now we will broadly look at these instruments. In the quantitative instruments, we have bank rate, open market operations, repo rate, reverse repo rate, cash reserve ratio, and the statutory liquidity ratio. Whereas on the other hand, qualitative instruments will include margin requirement, rationing of credit, and moral suasion. Let us first discuss the concept of bank rate. Bank rate refers to the rate of interest at which the RBI lends money to the commercial banks. Earlier we have seen that commercial banks will borrow money from the Reserve Bank of India when they are in need of immediate money. In doing so, the Reserve Bank of India will fix certain rate of interest for lending money to the commercial banks. And this rate of interest is none other than your bank rate. An important thing to be noted here is that the money which is lent to the commercial bank by the RBI for its long-term requirements will be known as the bank rate. And the bank rate influences the market rate of interest. Now this market rate of interest is the interest rate charged by commercial banks to the general public. The general public takes loan from the commercial banks. For taking the loan, they are going to be charged a certain interest rate, and that is known as the market rate of interest. Bank rate will influence the market rate of interest if RBI decides to increase the bank rate. Then it leads to the increase in the market interest rate as well. If the rate of interest is increased, then the general public will be demotivated to take loans from commercial banks, because at a high rate of interest, the demand for credit by the general public will be low, as they have to pay more money as interest to the commercial banks. Conversely, if the bank rate is reduced, then it will lead to the reduction of market rate of interest as well. Now in this condition, the general public will be induced to take more loans from the commercial banks, which means that RBI can use this instrument to solve the problem of inflation or deflation. If there is inflationary spiral occurring in the economy, then the Reserve Bank of India will increase bank rates, increasing the market rate of interest, and hence the general public will then be demotivated to take more loans from the commercial bank, thereby restricting the supply of money in the economy. And this solves the problem of inflation. And on the other hand, the problem of deflation could be solved when the RBI reduces the bank rate, thereby causing reduction in the market rate of interest, and hence the general public will be induced to take more loans, which mean more availability of money supply in the economy, and the problem of deflation solved. Now let's come to the second quantitative instrument, which is open market operations. Open market operations. Open market operations refer to the sale and purchase of securities in the open market by the RBI on behalf of the government. By selling government securities like National Savings Certificate, most commonly known as the NSC, RBI will soak up, or RBI will absorb, liquidity from the economy. Now let's have a look at National Savings Certificate. It is an Indian government savings bond primarily used for small savings and income tax saving investments in India. It is a part of Postal Savings System of India Post. People purchase National Savings Certificate because it saves your income tax under Section 80C of the Income Tax Act of 1961. This is how National Savings Certificate looks like. It is a 1953 50 rupees post office National Savings Certificate. But now, since the 1st of April 2016, National Savings Certificate in its physical pre-printed certificates have been discontinued, and it has been replaced by National Savings Certificate on electronic mode. Now, by using this tool, when RBI absorbs cash from the economy, then the cash reserve which is available with the commercial banks are reduced, which means less credit creation by commercial banks. And on the other hand, if RBI releases the cash back into the economy, then the cash reserve will increase with the commercial bank, which will lead to more credit creation by the commercial banks. By using this tool, RBI can solve the problem of inflation by absorbing cash from the economy and reducing the cash reserve available with the commercial banks, thus reducing the credit creation ability of commercial banks and solving the problem of inflation. When the Reserve Bank of India releases cash into the economy, then the cash reserve of the commercial bank gets increased, and due to which more credit creation will occur in the economy, and hence solving the problem of deflation. There are two types of open market operations. First is outright, and this is the type of open market operation that we have discussed just now. The second type is known as repo, which we will discuss now. The next quantitative instrument is the repo rate. Repo rate. Repo rate is the rate at which the RBI offers short period loans to the commercial banks by buying government securities in the open market. And when we say open market, it means interbank trade in securities. Now this repo rate is somewhat similar to the bank rate, but the basic difference between the two is that while repo rate is the rate at which the RBI offers short period loans to the commercial banks, The bank rate is related to the long-term loans to the commercial banks by the RBI. Now this repo rate is part of the open market operation. Unlike what we have discussed in the outright sale of the open market operations, in the repo, a repurchase agreement is signed by the parties stating that the securities will be repurchased by the commercial banks on a given date at a predetermined price. Now, what happens in this repurchase agreement or repo is that RBI offers loan to the commercial bank by buying from them the government securities, National Savings Certificate, but it carries an agreement stating that the commercial banks will repurchase such government securities on a given date at a predetermined price. This instrument of repo rate could be used by the Reserve Bank of India in order to solve the problem of inflation or deflation in the economy. During inflation, the cost of capital is increased by increasing the repo rate. This lowers the demand for credit, and because of which the commercial banks will create lesser money supply in the economy, thus solving the problem of inflation. On the other hand, during deflation, the cost of capital is reduced by reducing the repo rate, which will then increase the demand for credit, and thus money supply will increase in the economy, solving the problem of deflation.